All right, so thank you for putting the paper on the program. So this is joint work with Will from Cornell, Polak from IIM, and also Chi Hong from Cornell, a very talented PhD student sitting here answering all the difficult questions and help me out. And so this paper, it will turn out to be a very simple paper, but we think that we personally think we are addressing an important question. All right, so this is about the inflation expectation in cryptocurrency investments. So people in this room, right, we are experts on blockchains and we ask a lot of sophisticated questions. If we walk out of this auditorium and ask people on the street, what do you care about cryptocurrencies? I think that the most natural question they will care about is like, why do cryptocurrencies accrue values and what is the demand for cryptocurrencies? Right, so we think that the fact that I think the laymen will ask this question suggests that this is probably a very fundamental question in cryptocurrency research. And as a matter of fact, over the years, there has been a lot of studies like trying to answer why do people want to have cryptocurrencies? Why do they want to buy cryptocurrencies from various different perspectives? But over the years, we think that there's also kind of the elephant in the room, and there's a lot of community discussions about cryptocurrencies serving as inflation hedges. But on the other hand, there's not much rigorous theoretical or empirical exercise in the academic literature. And what this paper tries to do is to try to provide some direct evidence establishing the connection between people's incentive hedging motives and their cryptocurrency purchase decisions. Okay, so the research question itself is not that complicated, and as I mentioned, there's a lot of discussions in the community, right? But I think one of the challenges that trying to establish it rigorously is that there's a lack of granular data available to researchers. We just don't observe people's cryptocurrency investment purchase decisions, right, at the individual level. Because these decisions, when you talk about trying to buy cryptocurrencies as inflation hedges, you're naturally talking about the trading fiat currencies versus cryptocurrencies. These activities happen on off-chain exchanges, and these data are typically not available to researchers. And so, and also, if we just do some naive correlations between cryptocurrency returns and the inflation expectations, we tend to have very mixed results because there are just so many noise that is there. So, as a matter of just like in summary, what we are trying to know is that we need some more direct evidence to answer, do households really regard cryptocurrency investment as inflation hedges? This is an empirical question, and we need data to tell us the answer. And also, if we can, suppose that we can establish this claim empirically, there's a lot of follow-up questions, right? Just quantitatively, how much does inflation expectation drive cryptocurrency investment? There are thousands of cryptocurrency out there. What cryptocurrencies that do households view as inflation hedges? Right? Does the result differ across different demographic groups? And what about emerging economies rather than like developed economies like we are here in the United States? So these are all the questions that we are trying to answer within this question. And also, we want to say that the question, the very first question, do households really regard cryptocurrency investment as inflation hedges? From a theoretical perspective, I'll have one slide to show that it's the answer, like our priors should be ambiguous. So it's really like the important research question that we need to look at the data and to give us answers. So how do we address this question? Right? As mentioned, there's data challenges to answer this question. So the power of our results come from the data that we have. So we have access to the proprietary individual level trading data from one of the largest cryptocurrency exchange in India. So this data gives us access to all the information about each trade, including the usual suspects like the timestamp, the size, the price, and what asset pair the trading happens. And also, very importantly, we have the trader IDs of each trade. So we actually know at the individual trader level, how do they actually do the trading? Okay. And associated with those trader IDs, we also have very rich demographic information about what these people are. All right, so we know their gender, we know their age, we know which city they live in, which PIN code they have. The PIN code is kind of you can think about the Indian version of zip code. Okay. And so we are going to connect this data, this proprietary data that we have access to, and connect that with the inflation expectation survey of a household that is run by the Reserve Bank of India. This This survey is conducted roughly every 2 months, like there are some tiny differences. And it also, what's great about this data, that inflation expectation survey data, is that it also have localized demographically separate data on inflation expectation. So we can really connect these data to answer the question that we put forward at the beginning of the talk. All right, so with a rational expectation that I probably will run out of time, so I will just give you the preview of all the results. So just in case I run out of time, you will not miss anything. All right, so what are the main findings we have? We find that quantitatively, a 1% increase in 1 year ahead inflation expectation is associated with about 1,000 more rupee of net crypto purchases per investor in the next period. By period, we mean the time period between one survey, inflation survey, versus the next inflation survey. So roughly about 2 months. Right. So second, this kind of answers question that, well, there seems to be some correlation between inflation expectations and cryptocurrency investment. And we also find that this result shows some heterogeneity across different crypto assets. So the result is significant for Bitcoin, probably because the first and the largest cryptocurrency, and importantly with a fixed supply, right? And also it's pretty significant for Tether, one of the most dominant stable coin, which is pegged to US dollars. And the results is not significant for other cryptocurrencies. There are a lot of large cryptocurrencies, but we don't find these inflation hedging motives results there. Okay. And we also find the results are heterogeneous across different geography and different time. I will give you some illustration by the end of the talk, if we have time. And there's no significant difference across demography, at least within our sample. Okay, even though we find that there's significant difference between like men and women and young people and old people in terms of their inflation expectations. But the relationship between inflation expectations and cryptocurrency investment themselves, we don't actually see significant results across these demographic groups. And finally, we want to argue that the first bullet point that which I just pointed out also have causal interpretations. And as we will use the current inflation as an instrumental variable for inflation expectation to establish causality, so that we can claim that the inflation expectation really lead to the cryptocurrency investment decisions, right? So this is all we have, and maybe you can check out now. All right, so there's a large literature that we're going to skip. And so the remainder of my talk is just going to be just to give more details about what I have just told you in the previous slide. So the first question is, we want to just talk a little bit about why India. All right, so we are used to doing research for large established markets like the United States. And why do we particularly care about India? Well, we would argue that there are some pretty salient reasons why we should be caring about India. India is actually stands very top in the cryptocurrency adoption by Chain Analysis 2022 Global Cryptocurrency Adoption Report. It's number 4 in terms of global adoption. And the projection in terms of the growth is also pretty high. Okay, and also just like India is number 1 most populous country in the world, and the median age is actually 28. So they have a very young population. So if you think about young people tend to be more digitally literate, then maybe India is a market that we should be paying attention to. And also, importantly for India, that it's plagued by high inflation historically. So over the past decade, the average inflation rate in India hovers around 6.32%. Right? So the peak was at 2013, and that was at 10.91%. And the lowest one in 2017 is also about 3.59%. Right? So if we think we are really suffering from inflation here in the United States now, Indian people have been suffering that for decades. Right. So also for India, it's difficult to hedge inflation via other means, for example, fiat currencies. So you can think about that. Well, like a very natural way of hedging the inflation, the depreciation of purchasing power in rupee is, for example, to buy foreign currencies like US dollars. But the the Reserve Bank of India also has these very strict capital controls, so that it's actually very difficult for people to have those alternatives. So all these features suggest that it's a very natural laboratory for us to look into the relationship between inflation expectations and cryptocurrency investments. All right, so just give you some illustration about the inflation in India, right, over the past several decades, right? So like you can really see just that's the US dollar versus Indian rupee is just like shooting up. All right, so inflation is really a big problem for Indian. If you live in India, you should certainly care about inflation. I think you should, okay, at least. All right, so these are some numbers, and we can see this is just really summarizing the results that we have just showed before. The inflation rate over the past decade has always been hovering very high. We can also look at the exchange rate between US dollar and Indian rupee over the past decade, and we've put the result here. And we can see a lot of the inflation in rupee also is tied to the depreciation of rupee versus US dollars. That gives some suggestions that like anything, for example, a stable coin that is pegged to US dollars may potentially also be regarded as good inflation hedges. Right, so we're going to show that results later. All right. So this is just a bit talking about white India. And let me go very quickly, just one slide on a theoretical framework. I'm not going to go through this in detail, but this slide really what this is trying to argue is that this question, whether inflation expectation in cryptocurrency investment has any positive relationship, that is not a question that is ex ante clear. Right? So if we start off from some simple Euler equations to smooth income over time, to smooth consumption over time, and then we try to capture a asset's inflation hedging capacities with some parameters, and eventually we'll see that the investment investment decisions and inflation expectations will be captured by basically a function of the elasticity of intertemporal substitution and the assets hedging inflation hedging capacity. So like depending on how the parameters look like, the results may go either way. So that's why it's a really important empirical question for us to look into this. All right, so let's talk a little bit more about the data that we have. As I mentioned, the data comes from the largest Indian cryptocurrency exchange. So we have all the data from January 2018 to June 2022, and including, we have many trading pairs. And for every trading pair, we can think about, for example, we represent a BTC versus a Indian rupee. So that in this case, Indian rupee will be the base currencies. Right? So it's like a trading Indian rupee for Bitcoin. So we have the trading pairs, we have the timestamp, price, quantity of all these trades, and all the trader IDs involved in each trade. And I will have demographic information, as I mentioned earlier. And we also have then we also connect them with the inflation expectation survey of households. And so it includes the basically just like survey to a representative household over different geographic locations in India. So, and they ask question about what's your view on current inflation? What's your view on inflation 3 months ahead? And what's your inflation expectation for 1 year ahead? Okay. And these inflations typically come in rate buckets, for example, 1 to 2%, 2 to 3%. Unless it's above 16%, then the actual number will be recorded. Okay. And so we match our trading data with the inflation expectation survey data, and we get about 650,000 observations. So we can calculate the average inflation expectations within each match, and also we can look at the subsequent period volume of the investors' cryptocurrency trading amount, right, for each particular trading pair. So we are matching these two data, and we match by the geographic, the pin code, and the geography. So, okay, the pin code and gender. Okay. All right. No, I don't think gender. I think we match by pin code and city. Okay. So geographic information. Okay. So if we look at the summary statistics of the matched data set, so the median age of the crypto investors is 31. And probably not too surprisingly, the majority of the traders are men. And also there's quite a heterogeneity across different states in terms of their net crypto purchase amount. So we can see that we just plot on different states that there seems to be those southern states like on average, every investor trade more, okay? And also once we match the trader sample with the inflation expectation survey, we can also look at within the matched sample, what is their inflation expectations. So on average, the perceived current inflation inflation is about 12.27%, and 3 months ahead is about 14.4%, and 1 year ahead is about 14.1%. So we can compare those numbers with the survey itself, right? So if we do not do the matching and we just look at the inflation surveys across the entire population, we'll find that the inflation expectation in the entire sample is in the range about 10 to 11%. And so you can see that, so this is some suggestive evidence, right? Among those crypto traders, their inflation expectations seems to be actually higher than the national average. And this is also significantly higher than the historically average realized inflations. So this is kind of some suggestive evidence that, well, among those people who actually trade on cryptocurrencies, right, so their inflation expectations is a bit higher, okay? And there's also quite some heterogeneity across states in terms of their inflation expectations. So there are some geographic patterns that we demonstrate over here. All right, so let's talk about our empirical design. That's 5 minutes? 8 minutes, oh, okay, all right. So let's talk about our empirical designs and our findings, all right? So the empirical design is quite a straightforward Fama-Macbeth regression. So we are gonna regress for each investor, right? And for the T+1 period, we regress their net cryptocurrency investment amount on their inflation expectation, okay? And we're gonna control for age and their gender. That's why, like previously, the matching is not with gender because otherwise we cannot do that. Right? So this is the regression that we run. So why do we have this Fama-Macbeth regressions? Well, there are several reasons for that. One of them is just because the feature of our data, because anyone has dealt with retail trading data, we know that these retail investors, they don't trade very often. Right, so we don't want to care about the intertemporal decisions. We want to focus more on the cross-sectional differences, right? And also, so we want to extract the cross-sectional relationship between inflation expectations and cryptocurrency purchases. And also, running this Fama-Macbeth regression will also enable us to get those time-varying estimates. So we're actually going to plot that and see what time patterns we have coming out of these Fama-Macbeth regression. And as I mentioned earlier, we would like to establish causality of the results. So we will use the perceived current inflation as an IV for the inflation expectation. This is borrowing from the literature from Weber et al. Right. All right, so let's look at what the results that we get. So this regression table basically presents the results from the previous regression that we set out. You can see that like the investment amount regressed on the cryptocurrency cryptocurrency investment amount regressed on the inflation expectations. So if we regress on the current inflation, that's about 1,112 rupee. Okay, so the unit is really about rupees. And if we look at the 3-month inflation expectation or the 1 year ahead inflation expectations, they are all kind of in a range very close to 1,000 rupees. Right. So the 4th and 5th column, we look at the instrumental variable version of the regressions. So the results also remain pretty similar, right? So the magnitude really tells us that when there's 1% increase in the inflation expectation, that drives about 1,000 rupees worth of more cryptocurrency investment in the next period. All right, so we can have some placebo tests. So like all these results, right, is basically like people trying to, the base currencies is by Indian rupees, which is the majority of our sample. So people are really like, when we say net purchase, they're really getting rid of rupee in exchange for cryptocurrencies or stable coins. Right. If we use like a small sample of other trading pairs, for example, using USDT as base currencies or use Bitcoin as base currencies, then we actually don't really see those results. Right. So this suggests that like when there's inflation expectations, people are really trying to get rid of rupees and trying to get more cryptocurrencies or stable coin. All right. So this is the main result I have just presented to you. And then now let's look at some heterogeneity across different cryptocurrencies. Right, so we can just basically repeat our regression, but instead of looking at the cryptocurrency investment amount in aggregate, we can look at their cryptocurrency investment amount across different cryptocurrencies. So as we can see that the results are concentrated in USDT, that's Tether, and also Bitcoin. All right. So if we look at other cryptocurrencies, the results are basically not significant, except for this PTT, which is also negative. Right. So, but most of the results actually is concentrated in USDT as BT and Bitcoin. Right. Other cryptocurrencies does not seem to be perceived as inflation hedges. There's also some heterogeneity across states, so across geographic locations, because we do our regression right at those pin code level. So at the pin code level, then we can aggregate into different states. So we can get that the sensitivity between these cryptocurrency investment decisions and inflation expectations. Their relationship shows some heterogeneity across different states. We're still in the process trying to understand what is driving this heterogeneity. We don't currently have a very good idea about that yet, and we are open to suggestions. This is just a table. All right, so finally, 3 minutes, good. All right, so finally, we'll just look at some the heterogeneity across time. All right, so because we are running a Fama-Macbeth regression, as I mentioned, the benefit of running a Fama-Macbeth regression is that we can have the regression coefficients across time periods. Right, so this is the plot of the regression coefficient that we just like basically you can think about this 1,000, right? But it's across different time. And you can see that it seems to be that like around this 2018 and 2020 and 2021, that's the period when those the results basically show up. It's not the result doesn't show up homogeneously across different time periods. Right? So we have some hypotheses about what could be correlated with this result, whether it's cryptocurrency prices or is people's attention to cryptocurrencies. This is something that we are actively looking into right now. All right, so I think I'm probably going to be on time. So let me just conclude gracefully. Then, so what this paper tries to do is to provide some macro level implications from micro level evidence. So we have granular data to provide direct evidence showing that inflation expectations do drive cryptocurrency investment. All right, thank you.
A very graceful ending. I was not ready for it. Do you have any questions?
So thank you. That was very interesting. You focus on analyzing the intensive margin of the cryptocurrency investment.
Mm-hmm.
Can you look into the extensive margin? So is the increasing inflation bringing more people to invest, more new investors? Because you have this data, I think, into Bitcoin and Tether, and specifically whether there is a difference in the gender mix as the inflation expectation increases. So there are more women investing in cryptocurrency now that they see a practical usefulness for it.
Yeah, so that's a really good suggestion, and I think we need to check out whether our sample period length will have enough power to do that. But I think certainly in theory, this is something we can do, and it's interesting to look into. And indeed, you're right. Like we are looking really at the intensive margin, looking among those people, crypto investors, and what are differences. And certainly we expect that extensive margin probably is going to be larger.
You said that most of your investors actually don't trade that often, or they don't make these investments that often, as perhaps one would expect. So in your regressions, are you actually setting the left side, the dependent variables there to 0 when they don't trade?
Yeah,
You do.
yeah, exactly.
Hello. Yeah. So I wanted to ask, when you showed the chart right on the previous slide, it had like some sharp edges on like sharp peaks on like 2018, then 2021 and 2022. So how much like did you look into if that was just driven by momentum of the cycle, like whatever this crypto cycle was there? Was there any correlation between like people were just chasing crypto at that time, or like did you look into that?
So there's one thing that we can report, as I didn't, with some very new results we didn't get time to include in the slides, that the exchange conducted a survey about people's expectation about not just inflation expectation, their expectation about the cryptocurrency return. Okay, but this is a very limited sample. We have because it's a survey and people response rate is not necessarily that high. But we look at that, some preliminary result, we look into this, and we find that like it doesn't, if we control for that effect, it doesn't really change our results. So I mean, maybe that can address some of your questions.
Okay, thank you.
Yeah.
India has a 30% capital gains tax, which applies to crypto as well. As a result, I suspect that a lot of large ticket sizes are happening on global exchanges and not really on Indian exchanges, which is Indian money. So do you think that the tax affects or influences your analysis in any way?
I think that the fact that there are capital gains tax should be discouraging people from using cryptocurrency as an inflation hedge. So the fact that we still find results actually shows that, right? So the demand could actually be even stronger, right? Because it could be dampened by this this taxes.
Got it. Yeah. Makes sense. Thank you.
Yeah, thank you.
Hi. Did I see correctly that ETH was extremely negatively correlated in your findings?
No, not ETH is just not very significant. So ETH is over here.
Time for one more, so I don't know.
Oh, perfect.
How you deal with the institutional investors, and did you have these type of investors in your data, or they were just individual and then you classify them based on gender and demography?
So the data doesn't give us a distinction between institutions and retails. But from institutional knowledge, we think this exchange actually caters a lot to retail investors. And it's really our focus because we care about households' inflation expectation, how they drive their cryptocurrency investment decisions. That's not saying that like we don't care about institutions. And to the extent that if we in economic models, sometimes we think about this institution as representing households in certain sense, we can think that that also captures that. Of course, that's a kind of an indirect argument.
Thank you very much. I think it's a break time now.